Good afternoon, everybody. My name is Mike Camara with Bogart Wealth. Thank you for attending our webinar today. Today, we are on the topic of Roth versus traditional 401ks and IRAs. There's some legislation that is potentially going to pass that I think this topic is going to be fairly relevant around. I'll talk a little bit about that. Not anything that is actually law or going to be law, but some things to be aware of. But thanks again for the time today, and let's dive in. First of all, a little bit about us. Bogart Wealth is a registered investment advisory firm. We manage about 1.7 billion of assets. We've got about 900 plus households that we work with. 90% of our clients are major oil and gas. We work as a true fiduciary. What that means is putting our clients' interests first, no hidden agendas, always full disclosure. We have a team located in Texas, Virginia, and in Texas, we also have a tax team located here in the Woodlands. In Texas, we have two offices, one in the Woodlands, one downtown Houston, and then we have McLean, Virginia, that is our operational hub, and advisors work out of there as well. Our mission is to help our clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. This just lists a number of the things that we help our clients with. We also are really focused on the intergenerational part. Two of the biggest factors on anybody's financial life can be parents or kids. And when it comes to kids, especially this topic, when we're looking at savings, the sooner you can get started and the more that you can optimize how you're saving, the better off you're going to be. So part of our culture is to have our advisors available for our clients to talk to any kids, family members that we can ideally be of help to. So this is part of our retirement readiness series, and we've got a number of topics that we get into. We have our retirement planning timeline, the retirement income planning, Social Security strategies, tax planning and tax law changes. That'll probably be one that we're doing here pretty soon. Estate planning strategies, NUA and post-retirement strategies, long-term care planning, Roth versus traditional 401k and IRA, which is what we're going to cover today, and then the mega backdoor Roth conversions. So the agenda for today is to go through three main areas. First of all, covering the basics between after-tax and pre-tax savings, or traditional and Roth IRAs, as well as 401ks. Some general conclusions around that and some special situations. So the basics. First of all, there's two main ways that you can save in a retirement account. You can do it through a pre-tax savings or an after-tax savings. After-tax savings are typically done through a Roth. Another way to look at it is tax-deferred growth versus tax-free growth. There are limits as far as how much you can contribute, be it a 401k or an IRA, as well as limits as to whether or not you can contribute directly to a Roth IRA or a traditional IRA, and whether you get deductions, things like that. We're going to go into all of these topics here. There's also some early withdrawal penalties that you have to be aware of as far as accessing the funds. And there's, as with many things, some exceptions to that. As far as required minimum distributions, that's something you have to be aware of as far as taking money out once you reach the age of 72. So we'll cover that. But this is some of the agenda items on our basic topics here. So let's dive in. So let's start with a traditional 401k, IRA, 403b, or 457. 401ks, 403bs, and 457s are through employers. IRA stands for an individual retirement account, something you can set up on your own. Don't need to be employed for that. So what's the good part about that on saving on a pre-tax basis? So this is what is called the traditional 401k or traditional IRA. You save from your gross income, so saved prior to anything being taxed. You save taxes every year while also saving for retirement by doing this. So you have a lowering of your gross pay, so it saves you on your taxes. No tax on gains or appreciation until the money is withdrawn. So everything remains what's called tax deferred. No taxes on dividends, And typically with the 401k plan, you get some type of company match. Not all employers offer that, of course, but that is one of the benefits of the 401k plan savings. So here's the other part. There's a 10% penalty if you take any money out early. What's defined by early is 59 and a half, prior to 59 and a half. That's set by the government. That's an IRS rule. Every dollar, both the original cost plus appreciation, will be taxed as ordinary income when you take that money out. So you promise to take out every dollar during retirement. That's getting into the required distributions. The government enforces this. The schedule for required minimum distributions, again, begins at the age of 72. And if you don't take the amount that you're supposed to take out at 72 and every year thereafter, there's a 50% penalty tax for failure to withdraw on the schedule. So pretty big hit that you'd be looking at if you don't satisfy the RMDs. Now, Roth accounts, Roth 401ks, Roth IRAs, sometimes 403bs and 457s also have a Roth savings feature as well. So salary is contributed on an after-tax basis. So the money is taxed. It doesn't come from your gross pay like in the previous situation. It's taxed, and then it goes into either the 401k or the IRA or the 403b. So the attributable company match for 401k is contributed into a 401k or traditional 401k, a Roth 401k. So let me say that another way. Basically, any match you get, whether you're saving on a Roth or a pre-tax basis, that company match is always taxable. So you can consider that money pre-tax or traditional 401k money, irregardless of how you are saving. Roth monies grows tax-free. The withdrawals are also tax-free as far as the principal and earnings, as long as it's existed for 5 years and you're over the age of 59 and a half. A tax penalty of 10% on any appreciation or gains can be assessed if it's taken out early prior to the age of 59 and a half, or if it hasn't been as part of a Roth for longer than 5 years. Roth IRAs are not subject to required minimum distributions. Roth IRAs, however, 401ks, Roth 401ks are subject to RMDs. So a lot of times it can make sense to roll a Roth 401k into an IRA if you don't need the funds, if you don't want to actually have to take RMDs. Beneficiaries also inherit Roth accounts tax-free. So here's some examples as far as contribution limits to 401ks and IRAs. So the traditional amount that you can give if you're under the age of 50 is $19,500. Catch up for individuals over the age of 50 means that you can give an additional $6,500. The total plan limit from all sources, if you're under the age of 50, is $58,000. So that means that any company match, any profit sharing that an employer could put in there, the total, including what you can put in, is $58,000. If you're over the age of 50, you get that extra $6,500. So the total, theoretically, that you can put into a 401k plan if you're over 50 is $64,500. Now for IRAs, you can give $6,000 currently if you're under the age of 50. If you're over the age of 50, there is a catch-up contribution that you can do for an additional amount of $1,000. If you have, and that's non-deductible, so there's no income limit at this point as far as saving into a IRA and not getting a deduction. Now, in order to get a deduction, meaning that you save on your taxes, if you're covered by a plan, the income that you have is going to determine whether or not you get a deduction. So if you're single and you make above $76,000, or married filing jointly and make over $125,000, no deduction. If one spouse is covered, meaning you have one working spouse and one non-working spouse, or both working spouses, but one does not have a 401k plan available to them, they maybe work for a small company or something like that, then basically if it's above $208,000 of income, no deduction. Roth IRAs is basically a little bit different as far as whether or not you can contribute. So the previous slide, you can contribute, but it's a matter of whether or not you get a deduction. This is a look at whether or not you can actually put money directly into a Roth IRA. So same limits as far as how much you can do based on your age, $6,000 if you're under 50, an extra $1,000 if you're over 50, but the income limit a little bit tighter as far as how much you can actually make before you cannot put anything in there. So if you're single and you make over 140, can't save directly to a Roth IRA. Married filing jointly, can't save more or can't make more than 208,000. Otherwise, no savings to a Roth IRA. But for a Roth conversion at this point, and this is something I'll touch on as far as some of the proposed laws that might be coming into effect here, to convert money into a Roth, currently there's no income limit. So the great debates, pre-tax savings or Roth savings, which is better? Which should you do? The answer is it all depends. So let's take a look at an example here. So let's assume you're married. Each of you has an earned income of $80,000 per year, $160,000 combined income. Your marginal tax rate is 22%, which means that's the top rate you're taxed at. Keep in mind that taxes are progressive. So for example, it goes that the first $19,750 is taxed at 10%, then up to $19,751 up to $80,250 is taxed at 12%. And then the next bracket's taxed at 22, next bracket at 24, and so on and so forth. I'll have an example here. So just keep that in mind that taxes are progressive. You have $20,000 to fund your 401k combined this year. With a traditional 401k, you save $20,000 and that comes from your gross pay. So your taxable income now is $140,000. You're saving on taxes by saving pre-tax. With a Roth, you can save $15,600 because you again have to pay taxes on any dollar amount that you save. So the tax bill is $4,400. You actually are able to put in $15,600. After 30 years of this, of saving at this rate, at 8% returns, you would have $2,265,664 in pre-tax or traditional money. As far as Roth money would go, you'd have $1,767,218. Keep in mind that your savings come from the last dollar you earn. And what that means is you're saving from the top marginal bracket. So this money that would have been taxed at 22% had you earned it is basically being saved and avoiding a 22% top marginal tax hit. So then we eventually want to take this money out. After 30 years at an 8% investment returns, you again have these dollar amounts. For a 30-year retirement at 6% returns, you can withdraw $164,598 a year from the traditional or $128,386 per year from the Roth. To net out that same amount here, that's assuming that if the tax rate is 22%, then you have basically a break even. So at a 22% bracket, if that is what you're going to be taxed on both sides of it, then it doesn't matter whether you save on a Roth or traditional IRA, or excuse me, Roth or traditional 401k. If the tax rates are the same, there's no difference at the end of the day here. Now, if the tax rate is 22%, then after taxes, again, you're going to have these dollar amounts, $128,386, as far as how much you're taking out from your traditional IRA, assuming a 22% bracket. And then the Roth is tax-free because it was taxed at 22% previously as you were saving it. But the question is, will your tax rate actually be 22% in retirement? As I mentioned before, taxes are progressive. So you're not truly taxed at your top marginal rate. It's an average or an effective tax rate. So under current tax brackets, the marginal tax rate is 22%, but the average tax rate on these dollar amounts we're talking about is actually 17.1%. So when it comes to the traditional IRA, if you took out that same dollar amount, you would actually be assessed a 17.1% average tax rate, and you're actually netting out $136,452. So basically, you're saving on a pre-tax basis from your marginal rate. And then when you take it out in retirement, you're taxed at an average rate. So in the current environment, saving on a pre-tax basis is more favorable. If your tax rate is going to be lower in retirement, it's going to favor saving on a pre-tax basis. And for a lot of people, that is going to be the case. Now, as far as future tax brackets, how much do tax rates and brackets need to go up in order for there to be a break even? again, due to the progressive nature of taxes, income taxes would need to rise about 34% to make Roths be a break even. So a lot of times saving on a traditional or pre-tax basis is going to favor you in the long run. Now, again, this is just illustrating average tax rates versus marginal tax rates. So keep in mind the marginal tax rate is the top amount that you're taxed at. Your average tax rate is truly what you're paying. Really, all this is illustrating if your tax rate is going to be higher in retirement, then paying taxes now, if your tax is going to be higher later, makes sense. If the tax rate is going to be lower in retirement, saving money on a pre-tax basis now and getting taxed later on is more effective. This is just giving the example of what the tax brackets are. I mentioned them before. So you can see here, if you're married filing jointly at the 10% rate, going up to $19,900. And then when we're going from $19,900 to $81,000, that's taxed at 12%. 81 to 172 is taxed at 22. 172 to 329 taxed at 24. And then you get the jump here, 329 to 418 taxed at 32%, so on and so forth. So progressive taxes favor traditional 401k savings. Contributions are made at the marginal highest tax rate. So your contributions, if your top marginal rate is at the 24% rate, you're saving money that's basically not going to be taxed at 24%. And then if you take out that dollar amount within the range here, your average tax is actually going to be 20.4%. So you're saving approximately 4% off the top there. Withdrawals are made again at this average tax rate. So think of this as the tax rate that you're saving, and then think of this as what you're actually paying when you take that money out, because it's taxed at that progressive rate when you report it as ordinary income. So here's a little bit of a breakdown of 401k versus IRA contribution limits. Again, in a 401k, you can give $19,500 for 2021. That's the same as 2020. It's up from $19,000 in 2019 and $18,500 in 2018. We'll see next year whether or not they raise the amounts that we can save. There's also the $6,500 catch up that you can do in a 401k if you're over the age of 50. That's up from $6,000. That was the limit in 2019. And again, there's no income limits for Roth contributions. So while there's income limits as far as saving directly into a Roth IRA, there is no income limit to saving in a Roth 401k. Now, when it comes to IRAs, $6,000 again is how much you can save if you're under the age of 50. And that's the same as 2020 and 2019. It's up from $5,500, which was the limit in 2018. The $1,000 catch up again over the age of 50. And there's income limits for contributing to a Roth directly. $140,000 and above if you're individual, $208,000 and above if you're married. But there's no income limits again for any types of conversions at this point. So you can contribute to both the Roth and traditional. The thing to keep in mind is that is that you can't do, let's say you're under the age of 50, you can't do $19,500 pre-tax and then another $19,500 as a Roth savings. It's $19,500 total. Whether you do $19,000 pre-tax and $500 to the Roth or split it down the middle, whatever you want to do, you can do it. But it's the total between both sources. Same for the IRA. You can't give $6,000 to a traditional IRA and then $6,000 to a Roth. It's $6,000 in total. You could do $3,000 traditional, $3,000 Roth, whatever you want to do, but it's the total between the two. Key thing on this though is that you can save a lot more in a 401k than you can an IRA, and also get, in a lot of cases, the benefit of company match, which is basically them giving you free money to save for your future. So let's talk about early withdrawals and how you can access funds and penalties and things you need to be aware of when you eventually get to the point of wanting to take that money out. So typically speaking, if you take money out from an IRA or 401k prior to the age of 59 and a half, there is a 10% early withdrawal penalty. Now, with a lot of things, there's exceptions, and this is no different. So there's a few exceptions with this. One of them being if it's for qualified education expenses. There's what's called a 72T, which is basically setting up a 5-year annuity that pays an equal amount. That is one way to avoid the 10% penalty. Medical costs, but that has to be a lot of medical costs. Basically, expenses need to be more than 10% of your gross income. And then a first-time home purchase. What's defined by first-time home purchase is if you've not owned a home for more than 2 years, you could be considered a first-time home buyer. So that's some of the ways that you can withdraw money prior to the age of 59 and a half. You're still going to have ordinary income taxes in the case of a traditional IRA, but you can potentially avoid the 10% penalty. Roth contributions and conversions are penalty free after 5 years. So meaning that from your first contribution to a Roth, you have to wait 5 years and reach the age of 59 and a half before you can take those earnings out tax-free. So 401k penalties for withdrawals prior to age 59 and a half is the same thing. Same 10% tax penalty. This is a big one. One of the exceptions for pulling money out of a 401k plan is if you leave that company in or after the year you turn 55 and then take money directly from that 401k plan. That is what's called the rule of 55, and you can actually avoid the 10% penalty. Now, the thing with that, and this is especially prevalent for anyone with Exxon that's on this call, basically, every plan is a little bit different on how you can access money, how frequently, things like that. The Voya plan only allows you to pull money once a year. So you can keep the money in the 401k plan, utilize the rule of 55, take money from it, avoid the 10% penalty, but you got to really be careful with budgeting because you can only pull money once a year. Some 401k plans are different that allow you to pull pretty much however you want to, daily even, but the Exxon plan is not as flexible. But that is a key thing to keep in mind, that if you're retiring prior to the age of 59 and a half and you don't have any other assets outside of company benefits, 401k, pension, things like that, don't roll over your 401k to an IRA too soon, because this rule of 55 of accessing the money and avoiding that 10% penalty goes away if you take the 401k and roll it over to an IRA, because the IRA rules are up here and you can get some exceptions to that. But this basically 55 is all you need to be when you separate from that company. So don't roll over your 401k too soon. Roth is the same as traditional as far as accessing the funds. And again, a couple notes as far as education expenses. That can be for you or dependents, so it doesn't have to be your college expenses. More often than not, it's going to be the kids. 72T medical expenses already covered, and the home purchase. So the exceptions vary considerably. You got to really focus on what your withdrawal strategy is, especially if you retire prior to 59 and a half. Let's get into required minimum distributions. So RMDs for short start at age 72. They force you to withdraw a certain percentage from your portfolio. Oh, got a question. What happens when you establish a Roth after you have separated from EM, I'm assuming that's ExxonMobil, are older than 59 and a half on wait period for withdrawals? So the rule for establishing a Roth, there's 3 main ways you can put money into a Roth. You can contribute it, depending on what your income is, just make a contribution to a Roth. You can do a Roth conversion, or you can roll Roth monies, or I should say after-tax monies, into a Roth IRA. So if you have established a Roth after you separated from ExxonMobil and you're older than 59 and a half, if that's the first time you have put money into a Roth IRA, then you've got to wait 5 years before you can tap into any earnings tax-free, any growth tax-free. So FYI for EM participants, you might confirm the Voya withdrawal restrictions. My understanding was that we are limited to 2 per year, not 1 per year. I've heard that as well, but I've heard a couple people with that assumption of 2 per year, but I've always heard 1. So, something that Voya can ideally confirm, but our understanding is 1 per year. But again, if it's 2 per year, that's more ideal, but still a little bit restrictive. But back to that first question, just again, from whenever you put your first monies into a Roth, it has to be in there for 5 years. Now, that doesn't reset every time you put new money into a Roth IRA. It's not like, okay, if I saved, this year, that's 5 years, And then the next year, that money has to wait 5 years. It's 5 years from when you first fund a Roth IRA. So keep that in mind too. It doesn't just keep resetting and go indefinitely. The other thing too is that a lot of times Roth monies are some of the last things you want to tap into. Everyone's plan is different, of course, because basically Roths are growing tax-free. So as long as you can get that tax-free growth, you don't need to take it out due to required distributions. And a lot of times it can be passed on to beneficiaries, and we'll get into that stuff. But that's, again, even if you are retiring and you're over 59 and a half, it can make a lot of sense to start putting some money into a Roth. Another thing to mention is that if you just, even if it doesn't make sense on a, to save on a tax basis to a Roth, putting just like $100 into a Roth IRA or doing a quick conversion of $100 into a Roth IRA, that starts that 5-year clock. So you can start that 5-year clock with your first contribution to a Roth IRA, even if it's just doing a little amount, and then essentially satisfy that 5-year rule sooner. Got another question. Can you comment on tax proposal that will eliminate ability to convert 401k after contributions? Yes, I'll save that for the end of the presentation here. I certainly will comment on that. The thing I'm going to say right now is that it is proposed. It can change. It's not officially law or anything like that. But yes, I'll go through that. We also posted an article about it on our website. But yes, I will comment on that at the end of this presentation. Another question, if you are over 59 and a half and still working for ExxonMobil, can you draw from your 401k and under what conditions? So you can always, if you have after-tax savings in your 401k plan, you can always do a withdrawal of the after-tax savings as well as some of the earnings. That is my understanding of the only way that you can access funds is if you have an after-tax contributions, which means that you've hit the limit of the 19,500, let's say, under the age of 50, the 66,500 additional that you can do catch up. Then that spills over to after-tax savings. The Voya plan does allow you to pull twice a year, and that may be Michael, your misunderstanding on the limit, but you can actually pull after-tax money twice a year from the Voya plan and take it out to yourself as just a distribution or roll it over to an IRA. That's getting into the mega backdoor Roth that we like to do. But yes, if you're over the age of 59 and a half and still working at Exxon, you can pull twice from after-tax sources. You can also set up for, if you have Exxon stock in your 401k plan, you can also set up the dividend to pay out to you directly instead of being reinvested into the Exxon stock. Another way to get some money out of the Voya plan. And obviously that would pay every quarter. All right, so RMDs again, start at age 72, force you to withdraw a certain percentage. The percentage increases with age. You can withdraw more if you want to, but not less. If you withdraw less, that 50% penalty is going to be assessed on what you were supposed to withdraw. So the 50%, let's say you got to take $30,000 out for your required distributions. You say, no, I'm not going to do that. I'm only taking 20. That 50% penalty would be on what you didn't withdraw. So 50% assessed on $10,000. So not insignificant. And if you get to a much higher dollar amount, again, it can be painful. So RMDs apply to traditional IRAs, traditional 401ks, and Roth 401ks. Key thing here, Roth 401ks. They do not apply to Roth IRAs. So if you have Roth 401k money, you don't want to have to take it out. If you don't want to, roll the 401k over to a Roth IRA. You don't have to worry about it. And this is even if you're not working. If you're still working, you actually don't necessarily have to take RMDs out. All right, so this is looking at an example of required distributions. The key thing is to look at the percentages here. So this is also around some of the proposed law changes that are likely going to happen. The old percentages and distributions versus the new. This is back to 70, but right now it's 72. You can see that the percentage goes up. And it's not a flat percentage that they actually assess. It's based on tax tables and mortality rates, and they do a calculation, but it comes out to a pretty close percentage on what we're modeling here. You can see that once you get to, if you're fortunate enough to live into your hundreds, you're taking out a pretty large amount. And if you're fortunate enough to live to 120, the last year you live, you're gonna have to take out 50% of whatever your balance is there. So the whole thing is that, yeah, it's not too painful at the beginning, but if you're fortunate enough to live a good long time, that percentage is going to get pretty high. So some general conclusions around this. 401k versus IRA. savings are very different as far as how much you can save. The factors which favor a Roth may not always, a lot of people that I've worked with or start working with are saving on a Roth basically, when it could be more beneficial to them to save on a pre-tax basis, especially more of your high income earners. Now, if you're younger, when you're starting off and your income's lower, a lot of times it makes sense to put it into a Roth. But as your income grows and as your tax liability gets worse, it's going to behoove you a lot of times to switch that over to pre-tax savings. But early on, and this is going back to if you got kids that are working, saving on a Roth basis when your income's lower can favor you over time. And again, we talked about the factors which favor traditional traditional savings in a 401k or an IRA. All right, so a little bit more about a 401k versus an IRA. So basically use your 401k before considering a separate IRA. The reason that is that the biggest reason is that a lot of times you're going to get employer match. So that's free money to put money away for your future. There's higher contribution limits, so you can save a lot more in a 401k than you can in an IRA. There's potential for NUA. That's if you have employer stock. For the Exxon people on the call, if you got Exxon stock in there, this is a big one. We have a whole presentation around NUA, very complex topics. I'm not going to get into that right now, but just know it's a tax saving strategy. Eventually, you can roll over your 401k into an IRA and have a lot more flexibility as far as accessing the funds, doing conversions, doing NUA, things like that. Again, NUA is covered in another seminar if you want to learn more about that. So factors which favor a Roth 401k. If income rates will be higher when you retire than they are now. In my experience, that's usually not the case as far as looking at your marginal rate that you're saving at versus your average rate that you'll be paying in retirement. Again, all else being equal. If you expect your salary and spending to go up significantly faster than inflation between now and retirement, that's again, while your income's lower, you're starting off, a lot of times it makes sense to do it on a Roth basis, and then your income gets high enough, switch it over to pre-tax. Do Roth now and switch to traditional later. Again, if you got kids that are working, make sure they're saving on a Roth unless they're fortunate enough to start off making a lot of money at the beginning of their career. If income tax rates all go up in the future. Now, a lot of people do think the taxes are going to go up in the future, but not always the case. You look at the history of where taxes are, taxes today as far as brackets and standard deductions and things like that. We're in a more favorable tax situation now than we were back in 2015. But again, that's just depending on how you file your taxes. Not necessarily the case if you itemize, but taxes are a little bit nicer now than they were previously if you standardize. But that's again, if you think tax rates are going to go up significantly, and we saw that 34% increase you need to have for it to be above a break even, then basically Roth could be better. If you'll be an RMD prison, what that means is you saw those percentages as far as how much you have to take out of your portfolio. A lot of cases, we have clients that by the time they're getting to 79, 80, the amount they're required to take out is more than they actually have to spend. And so they're getting taxed more than they want to, basically. So that can be avoided by saving on a Roth basis or doing Roth conversions, especially in those potential early years of retirement when your income drops for some people significantly. So that's RMD prison benefits or it favors saving on a Roth basis, pay more tax relative to required living expenses like I covered, and Roth can help reduce the pain. Also, if you anticipate leaving a large legacy to family, keyword family, inheriting tax-free money is better than inheriting taxable money. And we'll get into that in a little bit more detail further on here. So factors which favor saving on a traditional 401k or on a pre-tax basis. If income taxes will be lower in retirement versus now. Also, again, keeping in mind the progressive nature of tax brackets. That just favors traditional, all else equal. All contributions are made on marginal dollars, which means you're saving from the top tax rate that you'd be taxed at. And withdrawals start after Social Security income. Future tax law changes. This is, again, if we have a flat tax, one can hope, one can wish, I guess. Flat tax might mean a lower rate overall, or if there's a national consumption VAT tax, which would favor, again, traditional over Roth, likelihood of that, debatable. If you anticipate needing to draw down all or nearly all of your retirement savings, in other words, RMDs are not an issue, that surplus is not an issue, or if you anticipate leaving a large legacy to charity. Keyword charity. Charities that inherit or pre-tax money from retirement accounts, they don't get taxed on it. So let's talk a little bit about some special situations. We're going to talk a little bit more about surplus RMDs, saving in a 529 versus an IRA for college expenses, savings beyond a 401k, and then a big one. This is probably most prevalent for people to understand is inherited IRAs. So let's talk a little bit more about surplus RMDs. If you live long enough, you will end up either depleting your IRA assets or with your required distributions being greater than what your living expenses are. As I mentioned before, that's a surplus RMD. So for most people, it would take a large RMD surplus to make your average tax rate surpass the marginal tax rate that you're saving at. So you can see how much of a surplus that would be if you're in the top 24% tax bracket and your average tax rate, to get your average tax rate up to 24%, that'd be an increase of 40%. That's if you're single. Surplus RMDs, again, if you have large surplus RMDs, you have a number of options to kind of consider. Consider saving in a Roth 401k now. Consider a Roth IRA or conversions now. Consider IRA conversions after retirement. That's usually the most effective way to go, but prior to the age of 72. That's again because usually your income is going to drop pretty significantly in those early years of retirement. You can also consider gifting. Fund a Roth IRA for working children, but keep in mind that the 5-year rules apply before you get the full tax benefits. As we've covered before, for contributions, Roth IRAs must be in existence for 5 years or more. That's what I was mentioning. You can just squeeze in a tiny amount into a Roth IRA, get that 5-year clock started, then you don't have to worry about it down the road. Conversions, same thing, must have been made 5 years ago or more. So a little bit of a decision tree to talk through as far as whether or not to do a conversion. So do you think you'll be in the same or higher tax bracket when you retire? If no, converting to a Roth IRA may not make sense if the conversion tax rate is greater than future tax rates. However, analysis still may be necessary. If yes, then what's your time horizon? Do you expect to start making withdrawals after 5 or more years? If no, your time horizon is not sufficiently long enough. If yes, then tax payment. Do you have enough money out of pocket to pay the taxes? Because you do the conversion, you're going to owe some taxes. And a lot of times we'd rather pay that from a savings account or a checking account than pay it from the actual conversion amount itself. Then a Roth conversion may make sense for you. If no, if you can't pay the taxes incurred from a conversion, you have other sources, then converting to Roth IRA may not make sense. If you pay taxes from the IRA, you lose the potential advantage of tax-free growth on the amount of taxes for those under the age of 59 and a half. And you'll likely potentially incur a penalty too. So Roth conversion, tax rates and the opportunities. So low tax rates early, higher tax rate in the base case if you do nothing as far as Roth conversions. This is an example of a Roth conversion analysis that we've done for somebody. So you can see that after they retire, they have a big tax year. That's because of some non-qualified plans that pay out. But then their income drops significantly and they're at a 10% rate. And then once they reach 72, they jump up pretty significantly to 33%. Then it gets to a 35% marginal tax rate here. So they go from a 10% top tax rate, marginal tax rate, and then by RMD age, they're at 33%. So significant opportunity to save on taxes. So based on, this is a larger example, but based on their spending and how much assets they have, they were to do nothing, they would leave behind a legacy of almost $13 million. Now it's $13 million in future dollars. If you put that $13 million in future dollars, if we factor in inflation, is not worth what $13 million is today. In today's dollars, that's maybe about 4 or 5 million, something like that. But basically, they would leave in the base case of not doing any Roth conversions, just a little bit. There's a little bit of Roth monies they had, but about $170,000. They would have taxable money of 4.7. What's taxable money is just think of that as like non-retirement money. So brokerage accounts, checking, savings, things like that. Tax deferred assets are traditional 401k, traditional IRA, pre-tax money. That's the breakout between the three here. And so we put together a Roth conversion strategy. of doing, and again, these are kind of big numbers, but $175,000 conversion in 2021, 181 in 2022, 196 in 2023, 146 in 2024, $700,000 converted over 4 years. So yeah, big amount. But when we crunch the numbers and do the math, instead of leaving taxable money pretty much for the most part, we're suddenly now leaving 3.2 million in tax-free assets. And so this gives the example as far as the impact on required distributions. So this is the base case as far as how much they would have to take out. And this is after doing those Roth conversions. The difference is about 1.7 million as far as how much they have to take out. Now, the bigger thing is how much do they save on taxes? Now, the full thing with this is that you got to live the full amount of time in order to enjoy the tax savings. So if you do these conversions and pay all this taxes in the first 4 years, and then you pass away on year 5, well, you're not going to enjoy the benefit. Your kids or whoever inherits the money is going to thank you for paying all the taxes for them when they inherit it, but you don't get yourself the tax benefit unless you live through this example, basically. But if you are fortunate enough to live to your 90s, in this case, the tax savings is $518,000 less in taxes that you're paying by basically front loading some Roth conversions up front and having less that you have to take out dollar amount wise here. As you can see the difference, 243,000 in 2045 in the base case versus 201,000. So the tax savings, $500,000, pretty significant. You can see the impact on effective rates. So again, effective tax rates, the average, not the top marginal. The effective tax rate in the base case would have been very low in these early years. So we bump it up to 15, 16, and 13%. Again, you don't enjoy the tax savings until you live a long time, or unless you live a fair amount of time. But you can see then that the effective tax rate between the base case and after the Roth conversion is saving about 1% or so over a fairly significant amount of time. And that's how we save overall on taxes. Like I said, if you did all this and then unfortunately passed away in 2027, you don't get the benefit of it, but those that inherit the money will certainly be thanking you. So let's talk a little bit now about 529s versus Roth IRAs for education expenses. So 529 has a lot of advantages. There's no income limits on contributions like there are with Roth. There's no tax on withdrawals for qualified expenses, and annual contributions can be much higher than for an IRA. So for a 529 plan, you can put $15,000 in there. If you're married, both you and your spouse can put $15,000 for a total of $30,000. You can also front load a 529. So you can put 5 years worth of savings into a 529. It's a total of $150,000. You can wait another 5 years and put another 150 in there. So you can put a lot of money into a 529. There are some limitations though. Taxes and penalties basically are going to be assessed if the expenses are not qualified, meaning you can't use it to buy your kid a car or something like that. It's got to be for education. And it can be considered assets on student aid applications. So be careful with that. You don't want to overfund a 529 plan because they're very rigid as far as what they can be used for. So generally you want to fund a 529 plan first. To avoid overfunding and putting too much into a 529, then you can consider doing Roth contributions or conversions. They can be withdrawn tax and penalty free for qualified education expenses, but not the capital gains. And then IRA assets are not disclosed on FAFSA, so you can avoid potentially missing out on some benefit there. But a Roth IRA, not a 401k, can supplement 529 plan savings. So savings beyond a 401k plan. This is again getting into the limits, 19,500 in 2021 plus 6,500 catch up if you're over 50. The maximum is 58,000, 50 and below. That's 2021 from all sources. That includes company match. Contributions in excess of 19,500. For an IRA, you can do an additional $6,000 plus 1,000 if you're over the age of 50. And a Roth conversion could be tax-free if there's no other IRA. So what I mean by that, this is getting into the backdoor Roth strategy. So if you make a contribution to an IRA and your income was too high to get a deduction, as the current law stands, you can convert that money into a Roth and not pay any taxes. So they call it the backdoor Roth. It's a way to actually put money into a Roth IRA if your income's too high. This is the thing that might be going away, and I will talk to that at the end of this presentation. Additional after-tax contributions can also go into a 401k. So technically speaking, if there's no company match, you can put in an additional $38,500 on an after-tax basis. Now, the difference between after-tax savings and Roth savings is that Roth savings grow tax-free. After-tax savings, that principal's already been taxed. You won't be taxed again on that. But anything that money earns is considered pre-tax money. So just easy example, let's say you put $20,000 into a 401k on an after-tax basis. Again, not traditional pre-tax, not Roth, just a straight after-tax basis, kind of a third source. That $20,000 has grown to $40,000, it's doubled. That $20,000 of growth will be taxable to you. The $20,000 that you put in there is not taxable when you withdraw it, or you can actually even roll it over to a Roth IRA. And then another way that you can save is just a regular taxable, or I like to call it a non-retirement investment account. That's just putting money into a brokerage account. Doesn't have the tax benefits of tax deferred growth or tax free growth. You get taxed on capital gains, interest, dividends, things like that, but you have full access to the money. So individual circumstances determine the best alternative. And that's where, we can look at everything for you and help you determine the best way to save. This is getting into the backdoor Roth IRA contributions. So you make and I explained this already, but you make a non-deductible contribution to a traditional IRA called a pit stop. And then you immediately convert that money and put it into a Roth. Since you got no deduction, when you convert that, there's no taxes, and you basically throw it into a Roth. So it's a pretty effective technique that we do. See if we'll still be able to do it down the road. Now we get into the mega backdoor Roth. And that's basically looking at that $38,500 that you can actually put into a 401k. It's a lot more that you can do. Basically, if you put $38,500 into a Roth, into a 401k on an after-tax basis, that after-tax money, if the plan allows, can be rolled over to a Roth IRA directly. Now, this is going to be, and I'll talk about this, this is going to be a little bit on what we need to get clarification on what is considered a conversion versus a rollover. Technically speaking, this is not a conversion. This is taking money from a 401k and rolling it over to a Roth IRA, so it's a withdrawal. So I don't know if the new tax laws are going to actually apply to this. Still waiting on some clarity on that. But basically, this is a way to put a lot more money into a Roth IRA if you're a high income earner and you're maxing out your 401k. We've got a whole presentation around mega backdoor Roth strategies. So check that out. A lot more details around that, but just keep that in mind as a very effective tax saving strategy. For anybody that's with Exxon, you have the ability to pull, if you have pre-87, post-86 monies in your 401k plan, another way to consider that is after-tax money. It's growing taxable to you. So if you take that money out and roll it over to a Roth, it's going to be growing tax-free. So take a look at your Voya statement, see if you have any after-tax money. If you do, there's probably some opportunity to optimize that and get it growing tax-free instead of taxable. Reach out to me if you want to talk more about that. So IRA beneficiaries, and this is a big one as far as how it works with inheriting IRA assets. So prior to the Secure Act, you could actually stretch out an IRA that you inherit and not have to, draw really too much out of it. But right now, if you are not an eligible designated beneficiary, and eligible designated beneficiaries are minor children of the person that passed, disabled persons, the chronically ill, not more than 10 years younger than the passed away decedent, spouses and certain trusts, then you can still do the stretch IRA. If you are a non-spouse inheritor and certain trusts, you have to actually take out the money within 10 years. And that's regardless of whether it's a traditional IRA or a Roth IRA. If it's a non-designated beneficiary, that means that you don't have any beneficiaries listed on your IRA. It goes to a charity or it goes to your estate. Then you have to actually take out in 5 years. And again, certain trusts apply for this. So bottom line, always have beneficiaries listed for your IRAs. I worked with a client recently that their mother had passed away and they didn't have beneficiaries named. It went to the estate. It was a tax mess. So always have beneficiaries designated on your IRAs. Now, a little bit more about inherited Roth IRAs. So your Roth IRA has no RMD, but an inherited Roth does. Spousal beneficiaries can choose to roll that over to their own Roth IRA, and then they don't have RMDs, so they avoid that. They can treat it as an inherited Roth IRA, no 10% penalty prior to the age of 59 and a half, and non-spousal beneficiaries it's always treated as an inherited IRA. So withdrawals from an inherited IRA, inherited Roth IRA, can begin at any time. There's no 10% penalty prior to the age of 59 and a half. Eligible designated beneficiaries can choose RMD based on their own life expectancy. If they fall into that category that was in the green in the previous slide, they can stretch it out. That applies again to spouses, minor children, disabled, or chronically ill. All others must withdraw 100% of the Roth IRA within 10 years. Now, you can do it however you want to. You can take it all out in year 1. You can take it all out in year 10, split it evenly within the 10 years, take half out year 5, the other half year 10. The IRS doesn't care. It just has to all be taken out in one way or form, 100% within that 10-year period. So individual circumstances will determine the best alternative as far as how to take that money out if you have to. Now, inherited traditional IRAs, it's the same thing, except you pay taxes, the person that inherited the money. So any lump sum distribution is going to be 100% taxed. Spousal beneficiaries have a few restrictions. They can roll it into their own IRA, and they'll be then on their own RMD schedule. So if the inheriting spouse is younger, they don't need the money, may want to roll it over so they don't have to take anything out. They can treat it as an inherited IRA, but then they're going to be on an immediate RMD schedule. A non-spousal beneficiary that inherits an IRA, they're eligible. They can do RMDs on their own life expectancy if they basically fall into the stretch provision, but all others have to withdraw that money within 10 years. So again, it's all got to come out. However you do it within that 10-year time frame, it's up to you, what's best for you, but it's going to be taxable if it's an inherited traditional IRA. So the biggest thing to consider there's a lot of factors that drive a traditional versus a Roth IRA decision. There's certain things you got to look at as far as, whether you yourself want to save on taxes, whether it can benefit you over time, or whether you want to take some tax burden on yourself so that your beneficiaries pay less taxes, your kids. There's certain situations that even if you are going to hurt yourself on taxes, I have clients that do that so that they can pass on a better legacy to family. Everyone's situation is different. But the things you got to consider are your current marginal tax rate versus future average tax rates. Social Security comes into play, savings and tax qualified versus after tax accounts, the expected required distributions versus your expected living expenses, future tax law changes, estate planning, legacy considerations, like I mentioned. Also, another thing that's not on here is Medicare. So you got to be careful of converting too much money in the 2 years prior to leading up to Medicare. You could end up putting yourself into a higher income bracket that basically causes your Medicare premiums to go up. So just be careful of that. So bottom line is it's complicated. One of our calls to action is to have a complimentary sit down with one of our advisors, myself or someone else, and we can put some numbers together. No commitment, no obligation. It's just a way for us to get to know each other, and we offer that as a complimentary service. And that's what's mentioned here. And then I'm going to get into some of the proposed changes, but thanks for attending. That's the presentation here. This is my contact information. My name again is Mike Camara, my phone number and email. Feel free to reach out to me directly if you have any other questions or you want to set up some time to talk. And we have our other advisors listed here if you'd rather speak with someone else. All right, I'm just going to click through a couple disclaimers. All right, so let me get into just a few of the proposed. Keep in mind, I'm going to say this again and again. It's proposed. It's not law. Don't make any snap decisions based on what may happen. It's proposed right now, but there's a number of things that are on the books here. But here's the ones that pertain to IRAs. First of all, they're looking to do no more Roth conversions for any taxpayers with income over $400,000 if you're single, or $450,000 if you're married filing jointly. Now, if your income's that high, more often than not, you're not going to be wanting to do Roth conversions at that point anyways. Wait until your income's lower, but that is one of the proposals. The big one is the end of the backdoor Roth and mega backdoor Roth conversions. So that applies to everybody. If you have typically done the backdoor Roth strategy, they're looking to eliminate that. Now, the key thing with that is, again, doing a conversion versus doing a rollover. A lot of the clients I work with Exxon, we do after-tax rollovers of money into a Roth IRA from their 401k. So I don't know if that's going to necessarily target that, because technically that's not a conversion. But if you do the regular backdoor Roth, or if you try to do an in-plan conversion previously, that is not going to be able to be done if this passes. And that would be effective as of next year, or technically December 31st of 2021. So those are the big ones as far as IRA. And there's a little bit as far as RMDs. Now, I think you're kind of fortunate if this applies to you, but basically you can't do a Roth IRA or a traditional IRA contribution if you have 10 million of assets in an IRA, a Roth, or a defined contribution plan. That's a 401k, 403b, and your income is over 400,000 filing single, or 450,000 married filing jointly. So that could be a limitation if you're fortunate enough to have that much in assets and make that much money. And then there's potentially going to be some additional R&D requirements. This applies to taxpayers that, again, have 10 million of assets in an IRA, Roth, or defined contribution plan, and income of over 400,000 if single, or 450,000 if married filing jointly. What it is basically, in addition to regular RMDs, certain taxpayers could be subject to additional withdrawal requirements of 50% of the value, so not insignificant, of over $10 million if you have over $10 million. And if tax deferred and Roth assets exceed 20 million, then Roth required distributions must be withdrawn first. So again, that's for some pretty large net worths there. But I think the biggest thing is that there may not be the capability to do the backdoor Roth contributions there. So please let me know if you have any questions. I'll stay on here for another minute if any questions come on. If not, thank you for attending. And please reach out if you'd like to set up some time to talk. All right, don't see any more questions coming on here. So thanks for the time. This has been recorded. It'll be posted on our website, so feel free to watch it again. A lot of information here. If you'd like the deck that I went through, feel free to reach out to me. I can send you the deck if you just want the deck for reference sake. But if there's nothing else, thank you for attending. Have a great day.